Futures trading involves substantial risk of loss and may not be suitable for all investors. Good afternoon, this is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago. Today is Wednesday, November 5th, and a lot of markets moving around. Grains continuing their rally to the upside, and cattle on the flip side continuing to bleed lower. Locked limit lower, so we've got expanded limits going into Thursday's trade. For live cattle, that's $10.75. For feeder cattle, that's $13.75. Let's just jump right into the charts here. We've got December corn futures pulled up, and we're still kind of in this meat grinder phase here, which is just trapped below the 200-day moving average, which we've talked about as overhead resistance, which happens to coincide with last week's highs. Whether or not that's a coincidence can be debated. Nonetheless, we're knocking on the door of a potential breakout there. We have been a little bit concerned about corn futures potentially pulling back in the near term, just on the basis of soybeans potentially needing a breather. Obviously, that didn't happen today. But the overall thesis there is soybeans have been able to rally, wheat has been able to rally, corn still largely sideways over the last week or so, so it hasn't been able to really participate in the upward movement over the last several sessions. But in yesterday's trade, it was a weaker trade on the back of a softer soybean trade. So if soybeans pull back, I would imagine that pressures corn a little bit. So I think the upside versus downside probably a little bit muted. Obviously, a breakout above technical resistance, that certainly changes the technical landscape. So from this price point, you need to figure out what you are. Are you a trader or are you a producer who needs to protect price and play defense? That probably sets you up how you're going to play that going forward. Now, moving over to the soybean market, as mentioned, just a continued breakout to the upside. We gained back all of yesterday's losses and tagged Monday's highs basically to a T, which sets us up going into Thursday's trade. 1150 is going to be that next psychological barrier. But all in all, I think these grain markets are setting up for kind of a more broader rally going forward. Is that going to mean that we go straight up from here? Probably not. Very rarely is that the case, but I think that we're now in an environment where we're going to start to see dips being bought up, and we can kind of stair step higher over time with higher lows and higher highs. With harvest basically all but wrapped up in the States, a lot of attention focusing in on South America. Not a lot of weather premium, in my opinion, down there. They're a little bit behind on planting pace for corn and beans due to some irregular rainfall, so that's going to be something to keep a very close eye on. We do have a South American dashboard that we're updating 3 times a week on our website, so if you have not signed up to get access to that portal, the South American dashboard, you can head over to bluelinefutures.com. Make sure you get signed up for that. Now, over to the wheat market, as mentioned, continuing to break out to the upside. We've been pretty friendly and optimistic on wheat prices for the better part of the last few months. We saw volatility at 6-year lows, daily trading ranges at 6-year lows. We got some breakouts above the 20 and the 50-day moving average a few weeks ago. And then to start this week, we had a breakout above 535, and that opens the door for an extension towards that yellow line, 200-day moving average and trend line resistance. That comes in near 566, 568. So that's the next upward target if we can keep this momentum going. Now, if you have been long this market for the better part of this rally, you probably will want to capitalize on it or at least protect some price from these levels. Wheat can be very unforgiving. It can give back a lot of these gains relatively quickly. So being able to capitalize on a good trade is really, really important in this environment, not just for wheat, but all the other markets as well. Now, jumping over to the livestock side of things, as mentioned, lock limit lower basically across the board, giving us expanded limits for Thursday's trade. The administration's stance to lower beef prices, or make an attempt to lower beef prices, continues to linger as a very, very big headwind for this market. And we've been hammering on this for basically the last month since the initial statements were released that, you know, if the administration and the U.S. government is coming out and saying they want lower beef prices, from a fund standpoint and a risk manager standpoint, they're not going to want to be involved with that. So you're seeing the mass exodus, long liquidation continue. Whether or not we get more headlines with the South American border or other steps to lower beef prices, you know, still to be determined. The cash market fundamentals remain relatively stout, but nonetheless, fund liquidation continues to rule the day here. This is the December live cattle contract, so the break below here, and you know you're looking at 210.17. That's 50% retracement from basically the whole year's range. So a lot of big levels to keep an eye on going forward. For January feeder cattle, we're basically at that 50% retracement with today's trade. If that holds 320 area, potentially we can stabilize and get a little bit of a bounce, but if that gives way, expect more downside pressure. I would have expected November to perform a little bit better, as close as it is to expiration and with where the CME feeder index is. So that's going to be something to keep a close eye on. If you want to be long the market, I would probably look at the very front months. The deferreds still make me a little bit nervous. Now, wrapping things up with the lean hog market. Lean hogs, we've been trying to be optimistic on the lean hog market, but it's just been beaten and battered and bled lower below the 200-day moving average this week. It tried to get out above there today, but couldn't get much of a meaningful rally. Lean hogs is setting up to be a similar situation to the wheat market, where it's just a quiet market. You see volatility at very, very low levels, so we like the upside in this market, but we've got to see some of these levels hold. 79.20s, that 50% retracement. Ideally, we want to see consecutive closes back above the 200-day moving average near 80.70. If we can achieve that, potentially that spurs some more technical price action and relief. In this market, we can get back towards at least the 20-day moving average near 82. Options are relatively cheap, with that volatility being relatively low. So I think options are a good way to either express an opinion in the market with an outright position or hedge futures. So there's a few different ways to play it there. If you have any questions over that, you can reach out to our trade desk. We are always ready, willing, and able to help. We put out a lot of great commentary in the agricultural space as well as other markets each and every morning. So if you've not signed up for a free trial of that, head over to bluelinefutures.com. And that'll wrap it up for today. If you have any questions at all, don't hesitate to reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.